Welcome to Finance Deep Dive. Today, we are going to talk about something really interesting, a way to play the market that doesn't actually involve owning a single share of stock.
Yeah, I know. It sounds kind of weird, right? But that's exactly what options trading is all about. See, it's not about ownership at all. It's really about making a focused bet on which direction you think a stock's price is headed. All right, let's kick things off. Part 1. From ownership to rights.
So, when you buy a stock, you own a tiny piece of that company, right? And you can hold it forever if you want. But options? Totally different ballgame. They're temporary contracts. And the key thing here is they always have an expiration date. That one little detail changes everything about the risk involved.
And this is the concept you absolutely have to get. An option is what's called a derivative. All that means is its value is derived from something else, an underlying asset like a share of Apple or Tesla. So just to be clear, you don't own the stock itself. You just own a contract that's based on the stock.
Now, this is maybe the single most important slide. There are two sides to every trade, the buyer and the seller. The buyer pays a fee, called a premium, and in return, they get a right to do something. Their risk is limited to that fee. But the seller? They collect that fee, but they accept an obligation. And that obligation can come with, well, potentially unlimited risk. Huge difference.
Okay, moving on to part 2. Let's talk about the bullish bet, call options. So what is a call option? Super simple. It's a bet that a stock's price is going to go up. It gives you the right, but not the obligation, to buy a stock at a set price for a certain amount of time. You're basically hoping the actual market price just skyrockets way past your locked-in price. Here's a great way to think about it. A call option is kind of like a coupon. Imagine you have a coupon to buy something for $10. If the store suddenly raises the price to $100, what happens? Your $10 coupon just became incredibly valuable, right? That's a call option. Now, for the person buying that call, the risk is completely defined. Let's say you pay $300 for that contract. If you're totally wrong and the stock goes the other way, what's the most you can lose? That $300. That's it. Your loss is capped. But for the person who sold you that contract, it's a completely different story. And frankly, it can be terrifying. If that stock shoots to the moon, they are obligated to sell you their shares at that low, locked-in price. Think about it. If the stock goes up forever, their potential loss is, well, it's unlimited. So you can see the two sides of the coin here, right? You've got the bullish buyer who's risking a relatively small amount for a shot at basically unlimited profit. And then you have the seller who's happy to collect that small fee but has to accept that massive, massive potential risk. Hey, just a quick pause here. If you are liking the content and finding this helpful, do us a favor and hit that subscribe button. It really motivates us to keep posting. All right, let's get back to it. Part 3 is all about the opposite bet, the bearish bet, with put options. So a put option is pretty much the exact opposite of a call. This contract gives you the right, but again, not the obligation, to sell a stock at a locked-in price. You buy a put when you're betting that the stock price is going to take a nosedive. The best way to think about a put is like in an insurance policy. You pay a small fee, your premium, and if the value of your asset, your stock, completely crashes, that insurance policy kicks in. It lets you sell at the higher pre-crash price, protecting you from a huge loss. And once again, you've got these two opposing forces. The bearish buyer is paying for that downside protection, for that insurance. And the seller? They're either neutral or bullish, and they're basically betting that the insurance won't be needed, so they get to just keep the premium. Now, traders have a whole set of tools to measure risk here. They're called the Greeks. We're not going to do a deep dive, but there's one you really need to know about: theta. Theta is just time decay. Because every single option has an expiration date, it's like a melting ice cube. It loses a little bit of value every single day. For an option buyer, time is absolutely the enemy. Okay, so for our last section, part 4, let's look at a couple of safer strategies, especially for beginners. So, the first strategy is that protective put we just talked about. It's super straightforward. You already own, say, 100 shares of a stock. Then you buy one put option for that same stock. What you've just done is create a price floor. You've basically insured your shares against a massive drop. It's a pure hedging move. All right, another really popular one is the covered call. Again, you start by owning 100 shares of a stock, but this time you sell a call option against those shares. Why would you do that? To collect that premium as extra income. Now, there's always a trade-off, right? The catch is you've just capped your potential profit. If the stock soars, you're obligated to sell your shares at that lower price. Look, if there's only one thing you remember from this entire explainer, please let it be this. The fundamental difference between the buyer and the seller is everything. The buyer's risk is limited. The seller's risk can be unlimited. You absolutely have to understand that before you ever even think about placing a trade.
We really hope you found this explainer helpful. And if you did, you know what to do. Don't forget to subscribe. It honestly motivates us to keep posting more of this stuff. So now you know the basics. Options can be a tool, or they can be a trap. They can be used for speculation, for insurance, or even for generating income. But they are, without a doubt, complex. So the real question you have to ask yourself isn't just, do I understand this, but are these a good fit for my portfolio? That's something only you can decide.